Hello everyone, welcome to the Ashworth Wealth Weekly Market Update. My name is Todd McChesney. Happy to have you with us this week. I want to kind of just go over a quick chart this week, kind of show you what's going on economically. This is a chart that shows the real gross domestic product minus or less the volatile components. Volatile components would be inventories and trade. Those are the two things that make up that. As we kind of see, we're trying to get a real picture for what the Fed is trying to do from a interest rate reduction standpoint. We really don't know what's going on. We'll know more next week, but we're trying to get a feel for what they're going to do, is how it's going to affect our portfolios. Number one, as you look at this, you can see that the real gross domestic product has been pretty steady if you take out those volatile components. 3.6, 1.7, 3.0, 3.3, 3.1. However, when you have inventories and trade that are causing more volatility, that can be a little bit more of a concern. Because of this, and because inflation appears to have, the reduction in inflation appears to have slowed a little bit the last little bit, there's some concern that there may be some stagflation. You can kind of see the market has been very volatile the last few weeks. We had a really great end of 2023, really great first quarter of 2024, and then all of a sudden some of these negative things started rearing their ugly head. So when we think about that, we're not too concerned about it, but the concern is does this affect the inflation from a stagflation standpoint? We don't want to have a slow growth and high inflation, which equals stagflation. We want to have the growth continuing, and we want this inflation to kind of get under control. As we look at that, you can kind of see where that's coming and what the trend is. Going forward, what this is going to do is it's going to cause the Fed to probably push a pause on interest rate reductions. The market had kind of priced in 3 or 4, maybe 3 to 5 interest rate reductions this year, which helps people that are borrowing, helps people that own fixed income, gets them a nice little pop in their performance of their bonds or their fixed income portfolios. But I think it'll be interesting to see what the Fed says this next week. We'll kind of have an idea of what's happening and what we can look forward to. For now, the market had priced in some of these interest rate reductions. That's why you're kind of seeing a little bit of a reduction in the market, or a little bit of some losses in the market these last couple of weeks. And not something we're too concerned about, but it is something that we want to kind of keep an eye on and see what's going on. So ultimately, the smartest thing to do is to continue to stay broadly diversified. If you have money on the sidelines that you want to get a little bit higher interest rate on, there's still bond portfolios that are paying really well right now. But for the most part, the key is to stay diversified and stay invested in the market. Let these things kind of work themselves out. Like we always say, in the short run, markets are always emotional. In the long run, markets are always based on profitability, and as companies and organizations make money, we benefit from that as investors. So with that, that's it for this week. We'll keep an eye on what the Fed does this next week. Keep an eye on that. Remember, if you have any questions, feel free to reach out to us at any time. We're more than happy to sit down and go over any questions you may have on your portfolio or on any kind of your planning items. Feel free to share this with any friends as well, and we look forward to seeing you next time. Thanks. Bye-bye.